Hello and welcome. You're watching Know Your Company. Today we're going to be covering Ashiana Housing, real estate play, of course, and an interesting one. It's a sub 3,000 crore in terms of market cap. And what I want to know and why we're featuring Ashiana Housing today is I want to try and understand. They've come out with their provisional numbers for FY25. There's been a slight bit of a miss in terms of that number. So whether there are any regulatory and approval challenges which are cropping up with regard to this company in particular, with regard to existing projects. That's the first piece I'm going to try and zoom in on. Second one I want to really understand is with regard to pricing and outlook for FY26 and the near term thereafter, whether there has been a significant shift in terms of either of those metrics, demand and pricing. The third piece I want to understand is they have around 2,100 crore of GDV, which needs to get executed, which is roughly 49% of what has already been received by them with regard to this execution of GDV. GDV being gross development value, and therefore all the development that they're doing should lead to some amount, which is 2,100 crore, to be recognized in the near term. How quickly are they going to recognize that? The approval status of existing projects, whether there are absolutely any approval delays that we are seeing at this point. I want to also understand the cumulative gross development value currently, because that as of now is not available in public domain, something I want to understand. New projects which are being considered going forward, what are the growth levers and how is that looking? Mind you, roughly 11,000 to 12,000 crore of execution is what they've guided for. That will come as part of our analysis, but that's something that you should know, given the fact that we are looking at the gross development value in cumulative that they are currently sitting on is what I want to understand. Now, the last piece is with regard to capital allocation. They're sitting on some amount of cash. They're also sitting on some amount of debt. The debt number, frankly, is very low. How are they incrementally allocating capital, and therefore what are the return ratios at which they are deploying capital is something I want to understand. So those are some reasons behind why we're going to be zooming in on Ashiana Housing today. Interesting play in the real estate space. Let me start off by explaining what the company does. In terms of Ashiana Housing, it's a mid-sized real estate developer, and it was incorporated in 1986, listed on the BSE in 1993, and thereafter listed on the NSE in 2011. It's specializing in residential projects in Tier 2 cities. It's a prominent player in developing housing for senior citizens. Now, in terms of segments, they are into the kid-centric home segment. They are into senior living home segment. So this is one real estate player which is developing a niche of sorts within these pockets. Premium homes is the other place where they are playing, and elite homes is where they are playing. So those are the 3-4 clusters that they are currently focusing on. A really wide geographical presence. Now, again, this is unique from a small developer perspective. Not too many small developers have such a wide range in terms of geography that they cover. But just look at some of those names, all Tier 2 plus cities. So again, it's Tier 2 plus, it's wide ranging, and it's in these specific pockets that they operate in. Something that you should keep in mind as we speak about the company even as a whole. That's the future projects, that's projects in the pipeline in terms of saleable area, but the gross development value of those projects will be crucial, and we'll understand that when we speak with the management. Now, in terms of what are the KYC metrics that we'll look at when we're speaking about Ashiana Housing. And I'm going to start off with the first metric, which is operational metrics, which we generally look at in real estate companies. Thereafter, we look at income statement and cash flow. We'll combine those two metrics. Balance sheet is the third metric, and return ratios is the fourth. Thereafter, we look at shareholding pattern. We look at street cred. We look at the outlook going forward, what the guidance seems to suggest. And last off, we'll compare the valuation at which this currently sits at versus some of the other players that are there in a similar market cap kind of space. So that's how we've kind of split up the metrics, and we'll hopefully dissect all of that for you by the end of this this show. Now, in terms of who's joining me, we have Anushi Vakharia joining me on this show to try and break these metrics down. Anushi, firstly, welcome Good morning. Wanted to first start off with those operational metrics that we always look at when it comes to real estate companies.
Of course. So before we go with the income statement for real estate companies, it's important to focus on how the booking values have fared in terms of how the area booked has looked at. So if you see the growth in the last 2 years or so, we've seen at a muted growth of around 2% in terms of how much area has been booked. We saw in FY26, 25, this number standing at about 26.97 lakh square feet. While in terms of value of area booked that we are looking at, here we have seen improvement in terms of where the land value is concerned. We are looking at a growth of around 8% in FY25, of course, aided by higher price realizations as well. In FY24 and FY23, there had been a substantial pickup in terms of these growth numbers that were there, around 37% of a growth last year. So overall, this is the picture that we are seeing over the last 4 years or so. But let's also talk about the fourth quarter, what has panned out for the company. In terms of area booked, we're seeing about a 20% of a dip in this number. While if you look at the value of area sold, that stands at 574.7 crores, seeing about a minus 33% of a dip as well. Do note that the company had guided for a 2,000 crore of overall pre-sales for FY25, of which it was shy of by around 63 crore. It reached a pre-sales number of 1,937 crore. So in terms of where the key operational numbers are looking at, that's what we are seeing. But Harsh, let's also talk about the income statement, right?
Yeah, let's do that. And it's not a very impressive looking income statement, also from a perspective that you will likely see that for real estate players, the execution is chunky. So something to keep in mind. FY25, and I'm looking at the numbers, not impressive at all. In fact, trailing 12 months, FY25 ended 9 months, which is not reflecting in the graphics in front of you, is just about 600 crore in terms of top line. But outside of that, it's grown at a fairly healthy clip of a low base. Mind you, for a 3,000 crore market cap company, it's doing about 1,000 crore in profit after tax. The EBITDA margins have gone up from 7 to 10 odd %, and the net profit also has gone up in similar kind of stead, as you can see. And for FY25, as I did mention, not a very impressive set overall, at least up to 9 months. So some bit to be done, some room to be left with regard to execution. And that's something, of course, we will ask management as well. So that's on the income statement. Let's look at the CAGR. And again, it's a 3-year sales CAGR of 57% off a very, very low base, and a 3-year profit CAGR of 147%, again, off a very, very low base. And loss making as well, in fact, a couple of years back. So something to be kept in mind. When you're looking at the standalone numbers for 9-month FY25, you can see revenue is in fact down 52%. EBITDA is loss at around 50 lakhs odd, and you have a net loss which is at around 2.1 crore, which has been clocked by the company. Now, so of course, that's the income statement. Let's also look at the cash flow while we are at it, because this kind of unimpressive number largely not translating to cash flow. Cash flow is reasonably better in that sense. As I did mention, when income statement is concerned, you will largely see it chunky. Cash flows may be the better way to look at it, but you would want a faster growth on a lower base where the cash flows are concerned. In fact, H1 FY25, the cash flow is negative 2.6 crore, and the net cash flow is, of course, looking positive at around 86 crore, which is in front of you. So that's how it's stacking up. We'll give this metric a neutral for the moment, both the income statement as well as the cash flow. You want to see more execution, and you want to see on this base whether Ashiana Housing can continue to execute. That's really the question. Anushi, balance sheet.
Right. So if you're talking about the balance sheet, let's just segregate it in 2 parts. If we take the equity shareholders fund in consideration, the equity share capital roughly to the tune of 20 crores. So considering reserves and other factors also, we are seeing at an overall unchanged value of 754 crore. This is the end of 9-month figure that we are looking at. But considering debt and cash flow position, it's a healthy picture that we are seeing. Cash, of course, eclipsing what the debt picture is. We are company currently sitting on a cash of around 343 crore, higher than that of the debt of 256 crore. In fact, when also asked about what their future plans are on the what the future plans is as per the earlier conversations, the company does not want to do fundraisers as well. So we are looking at a healthy picture in terms of the net debt picture that is there for the business, right?
Right, absolutely. And they're doing roughly 100 crore, at least in a normalized year in terms of cash flow as well, Anushi. So believe that that should not be a concern. Let's look at return ratios though. That's because that's the other metric you want to look at. The ROCE FY23, look at the numbers, quite unimpressive in that sense. ROCE and ROE numbers, sub 4%. It's obviously jumped in FY24, would have likely again tapered down in FY25. Again, you want to see more stability on this number. It's likely a thumbs down, but we're giving this a neutral only because we see it on an improving trajectory, and therefore, can this sustain and can the ROCE number or the IRRs within each project make good returns for investors on the invested capital that shareholders or the companies plowing back into itself is really the question that we'll try to answer again with management, but we'll give this a return, give this return ratio number a neutral for now. Let's look at shareholding pattern, Anushi.
Yeah, so in terms of where the shareholding pattern is concerned, there's nothing much to talk about here in terms of where the promoter holding is concerned. It's a flat number that we are looking at, no changes there. 61% is the shareholding that they had in March 25. Again, comparing this to the September picture also, there are not major changes that we are seeing. FII is also 7.74% is the ratio that we are looking at. So that has remained majorly in line. DI is again a similar kind of a ratio that we are seeing. Public holds about 23.4% of the stake in the company. So overall, this metric we have given a thumbs up, considering there are no major rejects or changes that we are seeing in terms of how the shareholding has panned out.
Yeah, just one quick point that I'd like to make here is that SBI Contra Fund holds around 7.5% stake in the company as at the end of FY25, 7.67%, and continues to buy. So they, at the start of the last financial year, they had around 6.7% stake, which they've hiked to 7.7% now. So something to be kept in mind. SBI Contra is one of the funds that looks at this particular company in positive light. Now let's look at street cred, because that's again the other metric that we try to track. And the last 1 month returns have been tough to come, negative 12%. The year-to-date period returns also are negative 25%. So we've seen a bit of a correction on the counter. The last 1 year, the stock is down 29%. And in the last 5 years odd, the stock has been a 6-bagger. So it's done clearly very well over the last 5 years odd. And you can see the kind of trajectory that even the numbers have taken, especially after the FY22 kind of period. It's really gone up substantially, but a lot of those returns have been front-ended. So in the first 3 to 4 years, we've seen very solid returns. Over the last 1 year, stock is actually down 30%. So a lot of the pain currently sits in the short to medium term with regard to this counter. So something to be kept in mind. We'll give this a neutral. Anushi, what's the outlook looking like? What is the guidance that the company is giving? And thereafter, we'll try and, on the basis of that guidance, try and extrapolate how do you derive a valuation with regard to this one.
Right. So let's talk about how the fourth quarter had panned out and subsequently the impact on the FY25 and the outlook forward that we are seeing. So in Q4, what we had seen is company had launched Ashiana Nitara, that's the phase 2 and 3 project that we are seeing, along with launched Ashiana Amara phase 5. That was conditional on the overall booking trends that we have seen for overall FY25. Now do note that the company had guided for around 2,000 crore of pre-sales by the end of this year. Company fell short of that target by around 63 crore mark. That is what we are looking at. Another concern has been some of the regulatory challenges affecting construction timelines of some of these projects that we are looking at. But on to the outlook forward, now company has given out a 5-year plan in which they have given higher weightage to the kind of return ratios they want to build in. They're expecting high teen margins over the next 5 years as well. So that would be in focus. This is in terms of PAT numbers that we are looking at. Along with that, they also plan to launch around 3 to 4 projects more. They plan to acquire land parcels, including a 20-acre site that we are seeing in Jaipur. So this is the overall picture that we are seeing for how the Q4 shaped up, leading to the kind of miss that we are seeing in terms of the FY25 number and how FY26 is expected to be going forward, right?
Absolutely. So therefore, given all of this, let's try and break down how the valuation looks like. And this is of course a very, very difficult job to do. But what we've tried to do is, and I'll explain this a little better, we've tried to pick companies within the 2,500 to 6,000 crore kind of market cap band. So you'll see the market cap here of each of those players: Ashiana, Arcade, Sunteck, Kolte Patil. And thereafter, what we've tried to do is basis whatever they have shared with us in terms of either their analyst investor presentations or in terms of the way we, in terms of the commentary that's coming through. This is the execution broadly. Broad number again, the approximate number in terms of execution over the next 5 years that's anticipated from each of these players, right? And thereafter, any guidance that they've given in terms of EBITDA or profit after tax. And I'll give you examples here. So for example, Sunteck has guided for an EBITDA of 21 to 23%. We've taken the profit after tax number at around 15% of the execution which Sunteck is expected to do on existing projects only and not on new projects. Again, a Kolte Patil, they've guided for around a 12 to 13% margin. We've deducted a decent amount in terms of interest cost, which is around 200 crore. On 25,000 crore, that's an EBITDA of around 3,250 crore. So we've deducted around 200 odd crore in terms of interest payouts, and thereafter, we factored in a tax of around 25% to arrive at this broad profit number on an execution size of 25,000 crore. So this may well change if any of these assumptions change, but broadly, as of today, as things stand, this is the broad profit after tax on this execution that the companies are going to do over the next 5 years. And thereafter, what we've done is we've just listed down the market cap. And when we are comparing the profitability with the market cap, what you're seeing is Ashiana trades at quite a large premium versus some of the other players. Some of the other players are just about a 10% premium at most. But Ashiana is at almost a 30 to 35% premium to the 5-year profit that we're extrapolating. Again, this may well change if there are projects which are added, and some of these numbers may well change if the companies go into new segments or new geographies. So some of these metrics might change, but as things stand, this is how we're looking at the valuation picture, and which is why we're giving Ashiana Housing a thumbs down. Also, mind you, and as Anushi has been arguing with me in the newsroom regarding this, Ashiana is in a very different segment compared to the others. But profits is really what we want to compare with the market cap, and this is 5-year profit, so it takes out any execution risk, at least from a near-term standpoint. So maybe for a year or two, there may be slower execution, delayed approvals, but despite that, you might still achieve that kind of profitability. So there are multiple things to be kept in mind, but this is broadly how we are looking at it. It's a tough one, but we've tried to piece this together, and we've given it a thumbs down, given the kind of delta that is there between this one and some of the others.
Right.
Yeah.
Well, yeah, that was quite a detailed piece. So this is what we are looking in terms of valuation picture. But, you know, let's in fact speak to the management to understand how the picture forward is going for FY26 and beyond. That is what we are looking. We had the management with us, Varun Gupta, the director of Ashiana Housing. My first question is regarding real estate as a segment. As we are seeing, they have been marked by the regulatory challenges. This year, you clocked in FY25 pre-sales at a number of 1,937 crore. This was against the guidance of 2,000 crores. So talk to us about the year gone by in terms of how the booking challenges are and some of these regulatory concerns which were there.
This number is in the context of 2,000 crores, our targets. We actually had good sales across locations, except we missed our targets in Gurgaon. The launch of the last phase didn't go as we had targeted at the beginning of the year, though we still had a good launch. We had no regulatory issues. We were able to launch our projects that we had planned to this year. And overall things, regulatory challenges were not part of last year in terms of launches and pre-sales. We have had some regulatory challenges in getting OC, so our deliveries have gotten delayed. So Ashiana Mall in Gurgaon, the OC came in now in April instead of March. So our delivery targets have been a little bit delayed because of regulatory issues.
Right. So considering that FY25 we saw about a 2,000 crore of a target, what's the outlook looking for FY26 in terms of where the pricing growth is concerned and also for the booking trends that we'll see? What's the booking value expected for FY26?
For FY26, also we are building a target of 2,000 crores itself, Anushi. We are looking at secular price increases across the board. Unfortunately, we have less stock to sell in one of our key markets in Jaipur, where we have to launch a couple of projects this year, and there are some regulatory challenges in getting those on board. And we have had limited stock because we found the land prices in Jaipur to be very expensive, and we've been holding off. So, with having little bit more limited inventory to sell, our annual targets are a little bit more constrained because of that. But we see secular price increases going forward.
Okay, so secular price increases in FY26 number remains at 2,000 crore. But out of the total area that you've booked so far, amount of around 2,100 crore is to be received in future. Can you break down the execution timeline for this number?
Most of this should get executed within the next 2 years. Some of it will go to 27, 28 as well. We actually give a delivery schedule in our investor updates. I'm guessing you're talking about this number from the December updates because the March updates have not gone in. The numbers of receivables will actually go up. And most of it should come within a 24-month time frame, and some of it going to a 36-month time frame from.
And Mr. Gupta, also give us a number for the gross development value on all the current projects that you have currently. If you can talk to us about this number.
So, current gross development value of all our projects put together, including what's under construction, is about 11 odd thousand crores. Uh, and we are targeting to realize the profits by FY30 of these values. And I've, as said, the expected after-tax profits from these projects is about 2,000 crores, and which we expect to realize over FY25 to FY30.
Just a follow-up on this, considering that current projects 11,000 crore is the number that we are looking at of the current land parcels that you're going to have, what is the kind of number that we look for that?
11,000 is inclusive of all the land parcels that we have, but excludes one parcel called Milakpur, which is stuck under litigation. So 11,000 is across the board put together.
Okay, and Mr. Gupta, how many new projects are being considered in terms of launches? If you can give us perspective, also the key regions where you're seeing most of these launches panning out. Give us a detail on that also.
So we have 4 launches planned for this fiscal year. Out of that, one is in Gurgaon, 2 is in Jaipur, and 1 is in Jamshedpur.
Okay, and of these new launches that are there, what's the gross development value for these projects?
So overall, the GDV of these projects combined put together is around 3,000 odd crores. Of that, we will not launch everything. So probably a quarter of it to a third of it will be launched. We like to phase our projects. So depending on the market conditions at that point in time, probably a quarter of it will be launched in this year.
Okay, and now one key risk that we are seeing for some of these real estate companies is the receipt of necessary approvals on some of these projects which are there. Any projects where you are seeing that approvals are pending?
So all the project launches that we're talking about have some approval risks attached to them. The comfort levels in Jamshedpur and Gurgaon are very high because we are at late stage of approvals. In Jaipur, one project has got even RERA approval, but which is a very, very small project. But the larger project that we want to launch, the risk on approvals there is higher and low.
Okay, so thank you, Anushi, as well as the management of Ashiana for giving us that perspective and that conversation with regard to Ashiana Housing. We of course also spoke with arcade developers earlier this month, so or rather late last month, and therefore a couple of those real estate plays coming into focus and a lot of perspective that gives us. But that's how the KYC rating. Ratings stack up with regard to where Ashiana is concerned. And Ashiana, out of all the rating parameters, if you look at shareholding as well, street cred, you know, the outlook as well as valuations, the KYC rating that Ashiana gets on the back of all of this is a 5 on 8. But it's been an interesting conversation. And Anushi, just with regard to perspective, you know, they have around 11,000 crore of existing GDV, another 3,000 crore likely to be added over the next year or so, all of which will likely get executed by FY30.
Right.
That's the aspiration. And at roughly a mid-teens kind of PAT margin,
yeah.
that's broadly how one should look at a company like this. But thanks so much for breaking this down with us today, and thanks for staying with us. Completely out of time on this edition of KYC. From Anushi, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.